Hello, we're now going to bring it all together in a comprehensive problem where we issue stock, both common and preferred, we pay dividends, and we also acquire some treasury stock. So to do it, I need to set up some T accounts. So we need a T account for cash, one for common stock, one for land, one for paid-in capital, one for preferred stock, one for treasury stock, one for dividends payable, or cash dividends payable if you prefer, and one for dividends or cash dividends. So let's see what we do. On August 3rd, we're going to issue 10,000 shares of common stock for $22 a share. So 10,000 shares times $22 is $220,000. So I'm going to be debiting cash on August 3rd for $220,000. The common stock is only going to be credited for $20,000 on the 3rd. And the reason is common stock may be no par, but it has a $2 stated value by the board of directors. So common stock will be recorded at its stated value. So 10,000 shares times $2 a share is $20,000. Paid-in capital will be plugged for the remainder, which is $200,000. So that's the 3rd. On the 15th, we issue 8,000 shares of common stock for land. The fair market value of the land is $100,000, so we'll record the land at $100,000 on the 15th. Because we're giving stock, 8,000 shares times $2 a share is $16,000 on the 15th, gets credited to common stock, and paid-in capital is plugged for the remainder, or $80,000 on the 15th. So that's debit land $100,000, credit common stock $16,000, credit paid-in capital for the $80,000. On the 22nd, we issue 5,000 shares of preferred stock for $500,000. So we're going to debit cash on the 22nd for $500,000. We'll credit preferred stock for the 5,000 shares, and preferred stock has a $100 par value, so 5,000 times $100 par just so happens to be 500,000. So there's no need for paid-in capital on the 22nd. On October 4th, we issue 5,000 shares of common stock for $60,000. So on the 4th, we're going to debit cash for $60,000. We'll credit common stock on the 4th for the number of shares, which is 5,000 times $2, which is 10,000. And paid-in capital comes to our rescue for the rest for $50,000 on October 4th. On October 10th, we purchased 2,500 shares of common stock for the Treasury for $6,500. So we're going to debit on the 10th $6,500 to Treasury stock and credit cash for $6,500 on the 10th. Because remember, Treasury stock is always recorded at its cost. On the 15th, we're declaring a quarterly cash dividend to the outstanding preferred stock. And here's where it gets a little fun, because notice that preferred stock gets a 6% dividend per year. So if it's 6% of the par value of $100 for the year, but notice that it says quarterly dividend, so we're only going to get 1/4 of it. So the dividend that will go to the preferred shareholders is 1/4 of their annual dividend, or $1.50. So we need to multiply $1.50 times the number of preferred shares, which is 5,000. So the preferred stockholders are going to get a dividend of $7,500. Now the common stockholders are going to get a 10-cent dividend. So we need to figure out how many shares are outstanding. And you'll remember that we started off with 10,000 shares outstanding. Then we issued another 8,000 shares. Then we issued another 5,000 shares. But then we purchased 2,500 for the Treasury. So the number of shares outstanding at the time of this dividend declaration then is 20,500 shares. And those 20,500 shares are each going to get a 10-cent dividend, which is $2,050. So when we look at our dividends on the 15th, we have preferred dividends of $7,500 cash, and we have common on the 15th of $2,050. So we're going to debit dividends or cash dividends, and we're going to credit dividends payable for the sum of those, $95.50, on the 15th of October. On the 25th of October is the date of record, and you remember there's no entry. And then on the 31st of October, when we pay the cash dividend, is when we'll debit dividends payable, $95.50, and credit cash for $95.50. So those are all the entries that happen to this business. We then continue on with our problem, and we'll prepare a shareholders' equity section based on the information that we have here. So watch the next video.